Okay, so this next video lecture, this is still the continuation of our discussion on our Module 2 entitled Cost, Concepts, and Classifications. So this time, we will continue with the classification of costs according to the timing of charge against the revenue. So in this type of classification, so this is when we will actually apply our matching principle. Okay, so here, this is the distinction between the cost and expenses that you have learned in the introductory part of this module. So here, if the costs are classified, or the expenditure, is classified as cost, then we will accumulate it and account those costs under our inventory. Okay, so while those expenses which do not have benefit or future benefits, we will classify them and recognize them as expense immediately. Okay, so for this classification, according to the timing of charge against the revenue, so the first classification that we have is what we call the product cost. So basically, when we say product cost, this is also known as inventoriable cost or capitalizable cost. So when we say inventoriable or capitalizable cost, this is what we are talking about, the costs which we will accumulate and account in your inventory. Okay, so this will form part of our inventory, and we will recognize the costs or these costs when these items of inventory are sold. So this is the matching of the recognition of our cost against the revenue. Okay, so here we will, or I am going to use our journal entry, okay, to explain further what product costs are. So in our production, okay, you will learn this actually under our module for the accounting of our materials, labor, and factory overhead. So there, upon the completion of the production of the goods, so your costs that or the costs that were incurred for the materials, factory overhead, and labor, we will credit them, and these costs will be transferred to our inventory account. So the entry will be to debit your inventory account. Normally, we are using the finished goods inventory account, and then credit will go to your materials, labor, and factory overhead. So this is the time when the transaction or the production, of the goods are finished. So here, the item is now ready for sale. So here, the costs are accumulated under our inventory account. And once the inventory are now sold, so our entry will be the first, there will be two entries. The first entry is to recognize the sales transaction. So the entry for that is to debit cash or accounts receivable and credit to sales. So that is for the sales transaction. The second entry will be to recognize the cost, or to match now the cost of this inventory against our revenues. So the entry will be to debit cost of goods sold or cost of sales, credit to inventory account. So here, please take note that the normal balance of our cost of goods sold is debit. Okay, so that's why we debited it, because at this time, or at the time of sale of the inventory, we can now recognize these costs. So that's why we debited the cost of sales or cost of goods sold account. And we credited your inventory account because we transferred these costs from the asset account to the expense account. Okay, so please take note also that what we include under the cost or the product cost are only manufacturing costs. So meaning costs incurred Indirect materials, direct labor, and factory overhead are the only costs, okay, that we can classify as product cost. So basically, these costs, as mentioned earlier, these are part of our inventory and will be charged against the revenue and recognized as cost of sales when the items or the inventory are sold. Okay, please take note of that. So in other words, initially, our product cost, they are classified as assets under our inventory account, and later on, we will transfer this cost to the expense account when they are sold. Okay, so all manufacturing expenses, again, direct materials, direct labor, and factory overhead are our product costs. So these three costs will be combined to form the products to be sold. Okay, so that's the important element in the transformation of the raw materials, okay, to finished goods. So hence they are called or termed as our product costs. So in the accounting records, okay, as mentioned earlier, normally we are using the finished goods inventory. Okay, so why finished goods inventory and not inventory in general? Normally, in the face of the balance sheet, what you can see there or what we can use is the inventory account. But under the notes to financial statements, there you will classify what are the items that are included in our inventory account. So in a manufacturing firm, usually we have three types of inventory. Okay, so the first is your raw materials inventory. The second inventory is work in process inventory. So this work in process inventory, these are the items which were already started, okay, in production but not yet finished, okay, at the end of the accounting period. That's why they are classified under work in process inventory. And lastly is our finished goods. So these are the finished products and which are readily saleable. Okay, so those are the three different types of inventory under our manufacturing firm. So, but here, we will use the finished goods inventory, okay, as the accumulation of our product costs. Okay, so the same in this case, when goods are sold again, okay, so the cost will be transferred from finished goods inventory to our cost of sales. So that's why again our entry is debit to cost of sales, credit to finished goods inventory. So this is the first classification under the timing of charge against the revenue. So the second classification of cost is what we call the period costs. Basically, period costs are just the opposite of our product cost. Okay, when we say period cost, these are the costs or expenditures that were not classified under the manufacturing costs. Okay, so period cost, normally, since they are the opposite of period cost, we do not capitalize or inventory it. When these expenses are incurred, they will be recognized immediately. Okay, so meaning these types of costs will not be accumulated under our inventory account. They will be recognized already as expenses. Okay, so period costs, normally they include the non-manufacturing costs such as your selling and administrative expenses. So they are not included in the inventory. Okay, so another example of period cost are your distribution expenses as well as the general and administrative expense. Those expenses which were incurred and are not part of the manufacturing costs. Okay, so again, these costs are presented directly as deductions under or against your revenue in our income statement. So the entry will be to debit the expense account, credit to cash or accounts payable, or other accounts that are appropriate. Okay, so those are the two types of costs under the timing of charged against our revenue. So we will proceed with the next classification. So this is according to the behavior in accordance with activity. So we have the variable cost and fixed cost as well as the mixed cost. So what is variable cost? When we say variable cost, normally this cost will be incurred once an activity is also performed. Meaning, if there is no activity, no expense or variable cost will be incurred. Okay, this cost follows the activity. Okay, so normally, variable cost, they vary in total in proportion to change in activity. So, for example, if your production is 10,000 units, so your cost will be equal also to the 10,000 units that was produced. Or if you produce in the next production 20,000 units, so your cost will also be equal to the 20,000 units that you produced. Okay, so it follows with the activity or number of units that you produced. Okay, so here, variable cost, they vary in total, okay, with the proportion, again, to the changes of activity. So what are the examples of variable cost? So variable cost, these are the common examples. We have the direct materials, meaning if you will produce a product, so you can account for the materials that is being used, okay, in the production of 1 unit or more. So basically, you will not use the materials if you will not produce. Okay, that's why that's variable cost, because it follows in the changes of the activity. Another is labor. So of course, if there is no production, so no labor should be applied for it. Okay, direct labor only. Another is sales commission based on sales. So meaning if there is no sales, there is no commission. Okay, so this is the behavior of our variable cost. It will be incurred once an activity is performed. Okay, that's the behavior of our variable cost. So if there is no activity, then no cost will be incurred. What about for fixed costs? So fixed cost basically is just the opposite of our variable cost. Okay, so these are the costs that remain constant regardless of the level of activity. So here, for example, if you are going to use or to produce, 100,000 units, for example, 100,000 units is the maximum capacity, okay, of your machine, okay, in producing the product. So, for example, you just only produced 80,000 units. So, meaning you did not maximize the full capacity, okay, of the machine, okay, in producing 100,000 units. But in this case, for fixed costs, regardless of the number of units that you produce, you will still incur the same expenses. Okay, so it does not follow with the activity. It is fixed. Okay, in what we call this, in a specific level. Okay, for in our example, the fixed cost is fixed only for 100,000 units. If you produce less than 100,000 units, okay, I am going to give another example. Your machine's full capacity is 100,000 units, and its fixed cost is equal to 1 million. Okay, and for example, you only produced 80,000 units. Still, your cost for 80,000 units is equal to 1 million, okay, fixed costs. So regardless of your activity, it remains constant. Okay. So what about, for example, if you produced 120,000 units? So this time, you have exceeded the maximum of 100,000 units. So in this case, the portion of fixed cost under that example is only 100 or 1 million. The next 20,000 units will be variable cost already because fixed cost is until 100,000 units. Okay, so that is what we mean later on by our mixed cost. Okay, but in this case, under the fixed cost, our common examples are the rent, insurance, depreciation, okay, using the straight line method. So in this case, in your depreciation expense, there are other methods that are being used, and some are based on the number of output, number of labor hours, okay, and so on, which makes it variable. But if you are using the straight line method, okay, meaning cost minus the salvage value divided by its useful life. So meaning to say every year you have the same amount of depreciation expense to be recognized. So that is under the straight line method. So in that case, depreciation expense now becomes fixed cost. Okay, so if we will apply this in our example, if your maximum capacity is 100,000 units and you only produced 80,000 units, still you will pay the same rent, the same insurance, and the same depreciation expense for the year. So it doesn't follow with any change in the activity, unlike your variable costs. That is the behavior of our fixed costs. Okay. And the third classification is mixed costs. So this is what I have given earlier, okay, in our example, in which in this case, these costs, or these are the costs that vary in total but not in proportion to the changes in activity. So mixed cost, basically this includes a portion of fixed cost and additional variable cost. So like in our example earlier, 1 million, cost of 1 million is fixed only until 100,000 units. And if you produced 120,000 units, the first 100,000 units, which is equal to 1 million cost, that is the fixed cost portion. In the next 20,000 units, which is additional, okay, that is now becomes a variable cost. That is what we mean by mixed costs. Okay, so what are the common example? Electricity. So here, normally in our electricity expense, this consists of a fixed amount plus variable charges based on units. So if you are going to look at your electric bill, so per kilowatt hour used, it has a fixed rate. However, because of some other charges, it becomes variable. But actually, electricity expense is classified under variable cost because your usage of electricity will depend on, the charge or the expense, for electricity expense depends on your usage. Okay, so that what it makes it, or that what makes our electricity expense a variable cost. Okay, so those are the three classification of costs according to their behavior in proportion with our activity. Okay, so we will proceed with the next classification. So this time, this is according to the relevance to the decision making. Okay, so here we have what we call relevant cost. What are relevant costs? relevant costs, these are costs that will differ or change under the alternative courses of action. In other words, these are costs which refers to those that will affect a decision. An example of this is when you graduated from your senior high school, basically you will be allowed now to apply for a job. So you have the option if you will apply for a job and not to or to continue to college. So in these two options, there is relevant costs. Okay, so here, if you will uh, uh, stop and look for a job, then you will have a salary. Okay, you will have an income. Okay, however, if you will choose to continue to proceed to tertiary level or college, then you will incur expenses for your tuition and fees and other miscellaneous expenses. Okay, so here, relevant cost is of if you will choose to continue to college, you will be spending expenses. While if you will choose to look for a job, so you will have this salary. However, if you will continue to or if you will continue to college and graduate, you will have a better opportunity, okay, to land in a job which pays higher compared to that salary which you are earning if you are not a college graduate. Okay, so in that case, relevant cost, okay, will make a difference, okay, in your decision making. So this will make it or these are the alternative courses of action that you will choose, okay, and it has costs along with it which differ from one alternative over the other, that makes or that influences, okay, or affect your decision making. This is what we call relevant cost, or in simple term, relevant costs are the cost that is not present in one alternative, okay, present in one alternative but not in another alternative. That's why it will have a difference in your decision making. Okay, this is what we call relevant cost. The second cost is the standard cost. So here, when we say standard cost, these are predetermined costs that is based on some reasonable basis such as past experience, budgets, industry standards, and so on. So these are the actual cost, or the actual cost incurred are compared later on to our standard costs. We mentioned standard costing before, okay, I think in the first module. Okay, so when we say standard costs, simply these are predetermined, meaning these are the costs that the management plans, okay, to incur in the next accounting period, meaning standard costs are in cost to be incurred in the future. So these are just estimated or budgeted amounts or figures. Okay, so basically this is used for planning and controlling purposes. So standard cost will be compared with the actual cost. Actual cost is the actual expenses that the entity incurred in the conduct or the performance of their business activities. So for controlling and for controlling purposes, this is, or the standard cost is compared with the actual cost to determine if the entity perform well or not. Okay, an example of this is the management plan for 100,000 expenses in the next accounting period. So this is our standard cost. However, when the actual performance were conducted, it was found out that the actual cost that they incurred was 200,000. So in this case, there is a difference of 100,000. So they are above what was planned. So meaning to say, in this case, the management can consider this excess as unfavorable because in that case, they have already planned that they should only spend for 100,000 only. Okay, so meaning the conduct of the activity is not efficient because they have exceeded 100%, okay, more than what they have planned for. Okay, so that's how standard costs are used in controlling. So basically, in the next accounting period, they will identify what items causes the increase from the planned costs or standard costs, so that in the next period, they will try to minimize or avoid it as much as possible to control the cost. So that is for our standard cost. Another is opportunity cost. So when we say opportunity cost, these are benefit forgone or given up when an alternative is chosen over the other. What is an example? Actually, opportunity cost also relates to our relevant cost. If you choose between, if you choose one alternative, then you will not benefit the, you will not gain the benefit of that will be given by another alternative. So we have here an example for opportunity cost. So example, if a business chooses to use its building for production rather than rent it out to the tenants, the opportunity cost would be the rent income that they will be earning, okay, had the business choose to rent out. So that is an opportunity cost if they or if the management decided to use their building for production purposes. Now, going back with our example earlier, under the relevant cost, if you are going to look for a job or continue to college, so your opportunity cost, for example, you choose to continue, okay, going to college. So the opportunity cost there is your income, okay, if you have a job already, okay, after your senior high graduation. So that is your opportunity cost. Okay, what about sunk costs? So when we say sunk costs, basically these are the historical costs that will not make any difference in our decision making. Meaning, sunk costs are expenses which do not have a future benefit. Okay, so sunk costs basically are the opposite of our relevant cost. Okay, so they do not have an impact on your decision. So an example of sunk cost is but for example is your payment for electricity. Okay, so that will be considered as a sunk cost because it will not give you any future benefit. Okay, and it will not affect your decision making. Okay, so those are sunk costs. And lastly is your controllable costs. So what are controllable costs? So these are the costs that can be influenced or controlled by the manager. So basically in an organization, they will have, in a large organization or business entity, they have different segments or division. So in each of these divisions or segments, it has managers or supervisors in it. So anything that any cost, that they can control, okay, these are what we call as the controllable costs. Okay, so this is what normally are used for evaluation based on cost. Okay, so an example of this are variable costs. Okay, because again, variable cost, this will be incurred only if an activity was undertaken. So if there is no activity, so no variable cost. So in this case, the managers can control such costs. Okay, so those are the different classifications of our cost according to their relevance to our decision making. So we will continue the classification of costs in our next video lecture.